Welcome to The Explainer. I am absolutely thrilled to guide you through this material today because honestly, we are looking at one of the most fascinating and frankly bizarre weeks we've seen in the financial markets in a very long time. We're zeroing in on the week of July 20th through the 24th, 2026. And this week was defined by a massive paradox. I mean, imagine a scenario where practically all the news coming out is good. Companies are beating expectations, revenues are up across the board, and yet the market aggressively punishes those exact same companies. It was a week where good news was repeatedly treated like a complete disaster. We're going to break down exactly why that happened, so you can understand the hidden mechanics driving this really strange market behavior.
Okay, let's dive into this. This question right here, this is the core mystery we need to solve today. What actually happens when good news just isn't good enough anymore? Because throughout this specific week, major companies were absolutely crushing their earnings reports, delivering numbers that, in any normal week, would send their stock prices soaring. But instead, the stock market tanked. Investors were hitting the sell button as fast as they physically could. But to understand this disconnect, we have to realize that stocks don't just exist in a vacuum. Before we look at the individual companies that caused this whiplash, we really need to look at the broader stage they were performing on. And that stage was defined by one word: unease. The macro environment, the big picture, global economic backdrop, was making investors incredibly nervous. Even before the very first earnings report crossed the wire, the foundation of the market was already shaking. We need to look at the global inputs that dictate how investors feel, because when investors feel uneasy, they look at even the absolute best news through this thick lens of suspicion and fear. To perfectly capture this anxiety, we're going to look at a checklist of 4 key numbers.
Section 1. 4 numbers pointing to unease. Every single one of these 4 numbers was pointing in the exact same direction, and that direction was warning. First up on our checklist, $92. This is all about oil. So at the beginning of the week, a barrel of U.S. crude was sitting comfortably around $82, but in just 5 days, it spiked up to $92. Intraday, headlines were even flashing the dreaded triple digits. That is a massive 10% jump in less than a week. Why? Because the U.S. and Iran were escalating conflicts over the Strait of Hormuz. That is literally one of the most critical shipping lanes for global oil on the planet. When conflicts flare up there, traders instantly price in the risk of tankers being blocked. And as we know, expensive oil is a massive problem for the rest of the economy. Which brings us right to our second number, 4.70%. This is the yield on the 10-year U.S. Treasury bond. It quietly sets the price for almost everything in the economy, from your mortgage to stock valuations. It started the week at 4.54% and climbed to a peak near 4.70%. Why the jump? Well, because expensive oil, like we literally just saw, triggers major inflation worries. Everything costs more to fuel and ship. When investors worry about inflation, they demand a higher interest rate to lend the government money for a decade. So oil goes up, inflation fears go up, and borrowing costs, they go right up alongside them. Our third number is 18. This comes from the VIX, which you probably know as Wall Street's famous fear gauge. What's so fascinating here is the suddenness of the shift. The VIX actually started the week looking really calm, sitting down in the mid-16s. By Wednesday, investors seemed totally relaxed. But then it violently spiked above 18 by Thursday and just stayed elevated straight through Friday. This sudden surge in fear happened right as a wave of disappointing tech reactions started hitting the market. The calm completely vanished in the span of about 24 hours. Finally, our fourth number, plus 6%. This tells a very specific and honestly somewhat worrisome story about metals. Copper, which usually tracks the actual health of the global economy, rose 6%. That tells us industrial demand is actually decent. But at the exact same time, gold was also ticking up. Usually, gold and rising interest rates do not move up together. When they do, it's a giant flashing warning sign from investors. Basically, it's the market's check engine light coming on. And this brilliantly illustrates what investors were actually terrified of: stagflation. When you see gold and interest rates rising together like that, it means investors are actively hedging their bets. They're preparing for a scenario where we get the absolute worst of both worlds: stubborn inflation combined with slowing economic growth. This fear of stagflation was the dark cloud hanging over the market. It was the lens through which all of that good news was about to be judged. Section 2, the AI spending spook. Now that we understand that nervous macro backdrop, let's shift our focus to actual company earnings, because this is where the real twist happened. The culprit behind the market's sudden drop wasn't a lack of revenue, but massive spending. Let's start with Tesla, which reported on Thursday. It was an absolute bloodbath. On the surface, revenue actually beat Wall Street's expectations. That should be good news, right? But the market looked under the hood and absolutely hated what it saw. Tesla's profit margins fell incredibly hard, and their free cash flow actually turned negative. Investors punished them severely for it. The stock dropped over 14% in a single day. To put that in perspective, this was Tesla's worst earnings reaction on record, capping off their worst single week since the great pandemic crash of March 2020. No way around it. That is brutal. Now, what's really interesting about this is the incredible disconnect we saw with Alphabet, Google's parent company. On one hand, revenue was up 24% year over year, and Google Cloud was up an astonishing 82%. Every single headline number destroyed Wall Street's expectations. But on the other hand, on the earnings call, the finance chief casually mentioned they are planning to spend up to $205 billion this year solely on AI infrastructure. We're talking servers, data centers, chips. That massive spending meant Alphabet posted negative free cash flow for the quarter, which is an incredibly rare thing for a tech giant of this size. The result? The stock fell over 7%. That $205 billion figure, it forces us to ask the exact critical question that is currently hanging over the entire artificial intelligence boom. At what point does all this spending actually pay for itself? This is the thought that completely shifted the market's psychology last week. Investors are no longer just blindly cheering for AI development, they are terrified of the price tag. They want to know when the servers and chips will turn into actual bottom-line profit. And we literally saw this exact same fear play out with Intel and IBM. Intel's numbers were genuinely excellent. Revenue was up 25%, which is their fastest growth in 15 years, fueled by a 59% jump in AI chip sales. The stock initially popped, but by Friday, nervous investors had dragged it right back down. It followed Alphabet's exact pattern. Then you had IBM, which told clients it was seeing a pullback in software spending. That warning added massive fuel to the fire, causing IBM to suffer its worst single trading day on record. The market was screaming, is the AI spending wave already bumping into its limits? But amidst all this tech carnage, there was a rare oasis of sanity, and it actually came from the industrial sector. Honeywell reported its first results as a newly streamlined automation company. Underneath some messy paper comparisons, their orders were actually up double digits, their margins expanded, and management even raised their full-year guidance. In an otherwise jumpy, terrifying market, the stock simply jumped and held its gains. It was a calm success story because it wasn't clouded by billions in vague AI spending. Let's move to and see how this builds into Section 3, a split personality market. Because the contrast between companies like Honeywell and companies like Alphabet resulted in a completely split personality market by Friday. The broader indices were telling two entirely different stories, depending entirely on what kinds of companies they held. Older, steadier companies in the Dow Jones with very little exposure to the whole AI hype finished the week roughly flat to slightly positive. They held steady. But the Nasdaq, which is heavily loaded with AI and chip names, suffered its worst week in over a month. And the semiconductor sector, the pure chip companies powering AI, they got absolutely hammered, dropping 9 to 10% for the week. Investors were so terrified of the AI price tag, they basically sold the tech sector first and asked questions later, leaving the older, steadier economy completely untouched. Section 4, the ultimate stress test. So the market is nervous, AI spending is under a microscope, and inflation fears are bubbling right back up. The upcoming week is shaping up to be the ultimate stress test. It is a massive, high-stakes calendar of events that will quite literally determine the short-term fate of the entire AI trade. I want to give you a concrete mental calendar of what to watch, because this is an absolutely packed week. On Wednesday, we get the Federal Reserve's interest rate decision. On Thursday, we get fresh, critical data on inflation and economic growth. And peppered throughout the week, we have the heavyweight title fights, earnings reports from Microsoft, Meta, and Apple. It is a back-to-back gauntlet of major economic events. Let's start with Wednesday's Fed decision. The market largely expects the Fed to just hold rates steady, especially with that recent oil-driven inflation scare we discussed earlier. But honestly, the actual rate decision isn't the most important part here. What matters is the tone of the press conference. All eyes are on Fed Chair Kevin Warsh. He's recently made a major point of publicly stating that inflation is still, quote, too high. If his tone on Wednesday implies that rates need to stay higher for longer to combat this new oil spike, the unease we saw this week will amplify very, very quickly. So the crucial point is how this sets the stage for the mega-cap tech earnings, Microsoft, Meta, and Apple. After what we just saw happen to Alphabet, where a massive earnings beat resulted in a sell-off entirely because of a giant spending number, every single investor will be watching these three companies for the exact same thing. How much money are Microsoft, Meta, and Apple planning to spend on AI infrastructure? If they can reassure the market that their spending is under control and actually paying off, the AI trade might stabilize. But if they spook the market with massive unexpected price tags like Alphabet did, expect absolute whiplash. Which leaves us with this final, incredibly provocative question to ponder as we head into this stress test. Have great earnings and safe to buy officially come apart? I mean, for a long time, if a company beat revenue and grew fast, it was a safe bet. But this week proved that the rules might be changing. The cautious mood, the fear of stagflation, and the total anxiety over AI spending have completely redefined what a good report looks like. Keep this question in mind as we watch the Fed and big tech navigate the week ahead. Thank you so much for joining me on this explainer. Keep learning, stay focused, and I'll catch you next time.